Hello traders, Gary Wagner here, approximately 1 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 26th day of March, 2021, and this is the daily report for gold and silver, our weekend review, and an interesting week in that. Today's show is going to be a little bit different in that we're going to focus very, very intensely on the U.S. dollar and the 3% gain that unfolded from the beginning of this year to current pricing. How that has affected gold prices is obvious because we pair gold against the dollar. And why the dollar has gotten strong is also fairly obvious. We are seeing an economic recovery from the recession caused by the pandemic. We're certainly not at pre-pandemic economic conditions, but we are seeing some improvement. And that's why the technical studies we look at indicate that we should see further strength in the dollar. However, there is one large caveat, and that is spending by the government. $4 trillion last year. Right now, we've spent $1.9 trillion on the Rescue Act, and President Biden is now proposing an additional $3 trillion for an infrastructure plus program, and that certainly would put pressure on the dollar, taking it lower. So we are seeing these cross currents working not together, but as opposing forces, and how that will unfold is something we'll have to see over the upcoming weeks. But I hope you enjoyed the show. Gold did stage a moderate recovery today, gaining $6.50 basis the most active April contract, currently fixed at $1,731.60. The question that we will raise on today's show is whether or not these gains are sustainable, because many of our primary technical indicators that we look at are still showing us the potential for more downside. The first thing I draw your attention to is our three moving averages, with the 50-day on the bottom, the 100-day in the middle, and the 200-day moving average on top. It clearly appears as though they are widening the distance between these three moving averages, and that conveys a continuation of bearish sentiment. We do have a proper bearish alignment, meaning the 200-day on top and the 50-day on the bottom. The second thing is when we look at our Henkin Ashi or Japanese average charts, and these are very good indicators of trend strength or weakness, we can see that even though we had a couple of up days this week, for the most part over the last 3 trading days, they have been red, small-bodied Henkin Ashi candles. Unlike what we've seen during hard sell-offs where we get strong, large bodies, but nonetheless, we have definitely seen a recent shift from small-bodied green candles to small-body red candles. And those technicals were part of the decision-making process that prompted me to pull profits on our long gold trade, making about $500 per COMEX contract. The other thing, of course, that we took into consideration was the dollar itself, because the dollar has been so strong. Now, it was down today, down about 0.12%, but when we look at the recent rise, we can see that it has been a scenario in which the dollar index itself, which was in full bearish alignment, meaning same as gold, we had the 200, followed by the 100, followed by the 50. You can see that it does appear as though the 50 will now cross above the 100-day, and we had closing prices for the last 2 trading days above the 200-day moving average. Also, when we look at our Henkin Ashi candles on the dollar index, what we're seeing is pretty strong trend development, no lower wicks, nice body size, and we are at a high that we haven't seen, I believe, since June of last year. We are looking at a long-term line chart going back to about the end of 2016 to current pricing of the dollar index. And the reason that I'm starting with this chart is it is recent dollar strength that has been such a bearish force on gold, which of course is paired within the dollar. You can see that we've had almost a 3% rise from about 89.30 to current pricing, even though it was down today, of about 90 to 71. And the other thing that you can notice is that For the first time in quite some time, we actually closed above over the last 2 trading days, the 200-day. The second thing that's extremely noteworthy is the fact that it appears as though when we look at the 50-day and the 100-day that it is a imminent cross. And that is one of the reasons that I believe we've seen the kind of pressure that we've seen as gold went into a rally mode. And traders, obviously, I spend a lot of time looking at the technical indicators, but we must acknowledge that it is fundamental events that really precipitate the fall or rise of the dollar. You can see that on this particular chart, which shows us what was occurring during separate periods of time. This, of course, is the financial crisis of 2008, the dot-com burst up here, the housing bubble, and so on. The dollar rises and falls based upon its relative value to a basket of currencies and therefore gets stronger or weaker based upon fundamentals in the economic environment globally. And traders, this next chart is again a line chart. This has the dollar index in green, gold represented in gold. When we take a look at the beginning of 2021, we can see that the U.S. dollar really was at a low coming off of these highs of 103 all the way down to this low. We did have a decline from the record high in gold as we went in the same period, but in approximately the middle of November, we saw it spike higher, and here we see that correlation with a higher dollar and lower gold prices. To answer whether or not this trend will continue has to do with the economic recovery following the recession that we are currently in, which was created from a global pandemic. Silver gained approximately 6 cents today, basis the most active May contract is currently at $25.11. One of the noteworthy aspects when we look at a Henkin Ashi chart, and that of course is on the bottom right-hand side of the screen, is we can see that predominantly this week we have seen large-bodied red candles indicating pretty strong strength in terms of a downward trend, but you can see today's activity. It really looks like it could be, in fact, a pivotal candle. It will be either a pivotal or a consolidating candle, because whenever we get these very, very small body sizes within a range that gives it wicks on both sides, it indicates either that the market is consolidating and forming a base at current pricing, or if it is coming off of a recent low or a recent high, it can represent that pivotal candle from, in this case, bearish to bullish. Although it has been in full bullish alignment and we've seen good action over this last week, we have definitely seen a pretty harsh price decline. This, of course, is a Henkin Ashi chart. What you can see is a couple of things that I believe are extremely noteworthy, and that is, first, we actually got the low that occurred yesterday to go into the 200-day moving average. And when we look at the activity over this last week, we can see that they are medium-sized candles, no upper wick, but today it appears as though we're getting a pivotal candle. Just as we talked about in the dollar index, a doji-like candle with this type of chart can indicate the forming of a base or consolidation, but it can also represent the point in time in which, in the case that I've just highlighted, when the market was selling off, when you had a shift from bearish market sentiment to bullish market sentiment. That, in fact, might be occurring now. We'll have to see how that unfolds throughout next week, because realize the equities market has been strong, which means that there should be good demand for the precious white metal. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.